So let's talk about investments for a minute. Like what you did to save and accumulate enough money for retirement. Okay. And then you move into, I've got this bucket of money, this portfolio of money. And basically, what do I do with my 401k, my pension, my Roth IRA, my 403b, my K plan or A plan or B plan, right? What do I do with those to allow me to go out into the world and spend money with confidence, even though the stock markets may be down, rates may be up or down, political fears, geopolitical risk like wars and that sort of thing. I mean, what are some ideas that you have around allocating capital to get people, to a 20, 30 year, 40 year timeline coverage?
Yeah. Well, for one thing, I would say I like people to back up a couple steps before they get to the investment portfolio. So I think the first thing, even if you haven't been a budgeting household in the years leading up to retirement, it's time to start tracking your spending and just trying to get your arms around what you're spending today. And, maybe you can back into it with credit card statements or something like that. But I really like people taking the time. It's not fun, but taking the time to do kind of a granular budget for my house where I'm figuring out what are my discretionary outlays? What are my fixed outlays? So I'd start there, like get my arms around what those are. And then the next step, I think, is to try to look at that fixed line of expenses, or it'll be a series of lines, where you're totaling those up, your housing costs, your taxes, whatever healthcare will be in retirement. And that may be a little bit different than when you were working, but the expenditures you have to make no matter what. Look at those. And then you mentioned earlier, Ryan, guaranteed income, non-portfolio income. That's where I would love to see people try to line that up. So can they get the Social Security? Plus, if there's a shortfall, maybe some type of a very basic annuity to line up with whatever those fixed outlays are. And then to me, everything with the portfolio and the plan gets easier if I know that those fixed expenses are addressed through those non-portfolio income sources. And then I'm constructing the portfolio to supply my discretionary expenses. And, sort of the rule of thumb I like to use is to think about maybe 10 years worth of portfolio withdrawals, earmarking that for safer types of assets, like maybe a little bit of cash, maybe fixed income assets. And then to my mind, the remainder of the portfolio can go into assets with higher growth potential, probably some sort of a globally diversified stock portfolio. So I would kind of see it as a 3-step process where you're doing that budgeting, you're looking at your non-portfolio income sources, and then after that, you're allocating the portfolio to support whatever discretionary spending that you might expect to have. And the nice thing about having the portfolio address the discretionary spending is that you're inherently going to be a little bit more flexible with those expenditures. And that is a really beneficial thing, because when we look at all of the research that's been done on retirement spending over the years, it's that if you can be flexible, if you can pull in your withdrawals a little bit in that sustained down market and perhaps spend a little bit less in a really good market environment like the current one, that is just a great thing to do in terms of your portfolio's ability to last over whatever your time horizon is.
Yeah, we call that a dynamic spending plan, right?
Exactly.
If the market's doing really good, maybe take a little bit more out, add some more to your cash bucket that year if you don't spend that money, right? And if the market's not doing great, maybe go to that cash reserve bucket. It's really interesting too. I follow Dr. Wade Pfau quite a bit. I'm sure you've heard of Dr. Pfau. He's got his RISA program, the Retirement Income Personality Awareness or Style Awareness. And I broke it down to a little bit further than that. I just said, hey, let's have a risk on style, meaning I'm okay having my income for retirement coming from risk-based assets, such as fixed income, stocks, international, whatever the equity positions may be. I've got enough assets to where if the market were to decline 20, 30%, I'm still going to be okay. And there's plenty of people out there that can do that. But then you have what I call the risk all folks. right? And some of the people out there, they don't want to depend upon the markets, whether it be bond or equity, or fixed income or equity, to dictate the quality of lifestyle they live in their golden years. And so they kind of glean more towards the safer investments, like a 30-year treasury bond could be an idea to fund your retirement, right? Because for 30 years, you get those interest payments. And if you retire at 60, 30 years out, you're 90.
Right.
So
Or a TIPS bond portfolio maybe is more what I would gravitate to, where you're getting that inflation protection embedded.
Let's spend a minute on that. All right. Because I hear a lot of experts talking about TIPS. And I one of the things I really like to do on the channel here is you and I can talk about formulas and Monte Carlo simulations and standard deviations and alpha and beta, probably till we're blue in the face. But our average listener doesn't really understand what that stuff is, right? What is a tip? Like, what does it do? How does it work? How can I use it to my benefit in my golden years?
Right. So these are securities. They're like treasury bonds. So they're guaranteed by the U.S. government, but they have another nice aspect to them that treasury bonds don't, which is that the principal value of your TIPS bond adjusts a little bit to help keep you whole with respect to inflation. So you get a little bit of an interest payment, but you also get that inflation adjustment on top of it. So that's why academic types often say TIPS are kind of the safest bond around, because they have AAA credit quality backed by the U.S. government which is as good as it gets. And then they have that bit of inflation protection to protect your purchasing power. So I think that they are a nice bulwark against inflation. If there's kind of a counterpoint, it's that they're a little bit inflexible. So if you build a TIPS ladder to match each year of your anticipated expenses, it's kind of hard to undo that once you've set it up. That's probably the main drawback. And happily, we're seeing some innovation in the investment product space, where I expect very much in the next couple of years, we'll see some neat products come online to help address that pain point of the inflexibility that you get with building a ladder of individual TIPS bonds.
Yeah, I agree with you too. A lot of the annuities out there, as complex as they can be, they're adding inflation riders now. A lot more of them are. And that can be helpful because you get a stated rate of growth each year. You get less up in the front years. So you could also use an annuity ladder. But, one of the things that we have to do as advisors for our client base is we have to decode the complicated formulas that insurance companies use to arrive at the amount of income they pay out for every dollar you invest. And it can be very complicated. But it can be simple. It's, listen, this company's got this rider with this roll-up rate and this income account value bonus and all these different things. But the only thing that matters is for your unique situation, for every dollar you invest, how much income do you receive? And can it be inflation adjusted if that's your concern?
I was going to say one knock on annuities, even though in general, I think that they can be pretty effective products, is just that I don't believe currently you can buy one that is linked to what the consumer price index is. You can buy kind of a fixed inflation rider, right?
Yeah.
And that's the beauty of the TIPS bond, is that whatever inflation is, if we have another repeat of 2021, 2022, where we had, very high, like 8% inflation for a year there, your TIPS bond is going to come through for you and help preserve your purchasing power. The inflation rider on the annuity, I think, is just kind of a fixed percentage. So that's a potential drawback.
Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.